Hello guys, welcome to the Trading Parrot. There are two major forces right now that could change everything for the next coming weeks and months for the market. And I think we need to take a seat and have a look at these different indicators to make ourselves a well-informed decision to pick which side we want to be in the market. Do we want to be in the right side or in the wrong side? As you can see, the alts are doing great. Bitcoin recently had a move to 35, 36 on some exchanges, but we are here to have a word of caution. I want to make sure that you guys have your feet on the ground for the next coming weeks. And there's some things that you really need to see before you start thinking that the next thing coming is Bitcoin at 40K or 50K. These two major forces are, number one, the stock markets. Traditional markets are going to have a massive clue on what's to come for Bitcoin. I completely disagree that Bitcoin in the long run can be decoupled from the stock market. Many people are talking about this. This is just a temporary circumstance only because Bitcoin is currently drunk on the idea of the BlackRock ETF approval. There is some ETF fever going on crypto Twitter and YouTube, and the vast majority of the people are subscribing to this idea. I get it. BlackRock is managing trillions. That is bullish. There's no way of denying that. But at the same time, we need to keep level-headed. Every single time that an ETF gets approved, it usually is the top of the market or at least a local top. And whenever a short ETF gets approved, it's usually marking the bottom of a market. The way it works is people have expectations on these events and they start investing upfront. The market runs, and as soon as they hear that the news are coming, they take profits either slightly before the event of the news or right on the event. So let's have a quick look at the S&P because there are clues here of what's to come. Currently, the vast majority are thinking that the S&P is on a small pullback. The expectations from people is that the S&P is going to bounce either on this trend line or is going to bounce on the 200 weekly. The bad news for those people is that there is a high chance that either the trend line or the 200 is going to get broken in the upcoming weeks. And this is just a matter of probabilities. I don't know the future. This is not financial advice, but the momentum from the RSI and the MACD is already broken. On the weekly, the S&P, you can see that it's doing a bearish structure. It's doing lower lows and lower highs. It's just confronting the trend line for the first time and it's kind of bouncing above it, but this bounce is not bigger than the previous red candle yet. We have the whole week to see how it reacts. At the same time, it's holding nicely on top of this horizontal trend line, which is providing this temporary support. But since the momentum from both RSI and MACD is broken, in fact, we are still only printing red candles in the histogram, the highest likely scenario is to break the trend line. In regards to the NASDAQ, around July this year, I shared on Twitter the signal from the Hive that was flagging a target to 14,000 on the NASDAQ, which just this week we managed to completely fulfill. If you're not following me on Twitter, I always share the signals, so make sure that you're subscribed to Trading Parrot on Twitter. So what's next for the NASDAQ? Well, this target was just twice the ATR, which is pretty easy to fulfill, but that doesn't mean that we cannot carry on going lower on the NASDAQ as well. The structure is bearish, is still printing lower lows and lower highs. The next major support is around here at 13.6. And similarly to the S&P, we also broke the momentum. This happened on August, and both the RSI and the MACD seem to be headed for lower levels. So after having checked the two major indexes, if we look at the DXY, it's also holding very nicely above this line that used to be resistance and now is being tested twice as support. So unless we break below this trend line and we prove that this was just a deviation, this might be ready for the next push up, which is definitely not bullish. So what is this telling us? Once this fever for BlackRock starts coming down, once the volume starts fading away as well, we should be expecting to see Bitcoin coming back to mimicking what the S&P is doing. There's only one caveat. S&P has been almost only going down in these moves around here. So we should expect some bounce, and that doesn't mean necessarily that it's back on bullish mode. It might be just a relief final rally before breaking this trend line down. Now, we have covered the first force that we need to be paying attention. The second major force that could play a big role to decide where is Bitcoin going to be heading next is the liquidity in the macroeconomy. And as we can see here, when using this indicator from Ted Toll's macro, the liquidity injections, we can see that the injections are increasing with every pump of injection. Beginning of October, we got 164. End of October, we got 194. And right now, there's a new injection that is taking us almost to 200. So this force is acting completely antagonic to everything that we were discussing initially in the video. Injections of liquidity definitely are bullish and are the only way that an asset can move up. You need more cash to be able to drive the market up. That's very typical of all markets, really. You always have forces, some things that are feeding the bullish ideas from some people and some things that are feeding bearish ideas from other people. When we look at high block capital, we can confirm that the market is currently very divided, almost in a 50-50%, even though there's a lot of new open interest in the market, meaning that so many new people are starting to trade. Attracted by this recent move of Bitcoin to 35K, we still see that the delta is not very significant. There's almost the same amount of positions from longs and shorts. This indicates that it's very difficult to forecast in which direction first things are going to go, because there's literally almost the same amount of liquidity to the upside and the downside, at least in the short term. Usually when we are in a situation like this, there is an explosive move, and there can also be a fake out, meaning that the price can go in one direction, liquidate some players, and then in the opposite direction ended up liquidating both of them. Be prepared for an aggressive move. Speaking of which, tomorrow there's the Fed meeting, 1st of November, and 97% of the people are expecting no change. So this could be a big source for a big move. There's usually a lot of volatility during these events, even if they confirm the news. Now, if we get a hike or an ease, the effects might be extreme. Personally, what I'm expecting to see is that there's not going to be any change, but at the same time, potentially, they're going to mention what is their approach for the next upcoming meetings. They might say that they are going to start to ease in December, January, or March. The only reason that they might decide to ease is because they are breaking something in the economy. Because in fact, the inflation is really not coming down, proving that the interest rates are not necessarily working. One extra thing that has me a little bit bearish as well is that on this move to the upside, we saw how spot were buying, at least according to CoinLies. These are all buys on spot that peaked precisely at 35K. From 35K, spot has been selling. There's almost no relief, no more buying, and it's reaching a level almost the same as the beginning of the move. And what that means is that the spot has come back to where it came from. There's no more buying. What was still a bit high is the positions using contracts on perpetuals. You can see that from the beginning, this went up, it reached a top. There's been only sells, but these sells are not coming back to where it came from. So these are positions that are still open on futures. Futures, in other words, is currently holding the price at these levels. At the same time, I'm starting to spot some sort of Bart Simpson pattern here. You can argue that this is also a bullish flag and it might explode to the upside. That's totally possible. But by seeing all these positions coming back to where they came from on spot, that tells me that the move might not be as sustainable as we think it is. And I'm not saying sell your Bitcoin, I'm not giving you financial advice, but this is a word of caution. According to FAR charts, there are two levels that we should be looking at in terms of liquidations. We have one level here at 35K. There's loads of liquidity from shorts here, so the price might visit this range just to get them liquidated. But if this happened to initiate a short squeeze with an impulsive move to the upside, the next levels are 37.7 and finally almost 40K. Interestingly, the view from fire charts is different from the one from Coinalyze, where we can clearly see that the largest whales have been all accumulating at 35, some of them sold, but then some others kept buying, as opposed to all the other holders that are still in selling mode. If we look at the liquidity levels from high block capital, we can see that the largest levels in the last month are located from 28K. There is some liquidity here at 33 and some at 35.3 as well, but it's not as significant. If we zoom in to the 7-day, we can see that there are levels at 35.2 again. So there is some liquidity from the last 7 days that is still holding there untouched. Let's have a look at the big boss of the bull market or the big boss of the bear market, whichever you prefer. This green band here has been holding the price for the whole bull market until we enter bear market. Here it became resistance. We revisit this area multiple times. We say it was going to take more than one try to break above. As you can see, the 25 held. This range is not clear and we are above it. But there's one thing that is missing. We still don't confirm this level by coming back to it and proving that we have fully conquered this new range starting from 34 all the way to potentially 48K. That could be the new range where we could be playing. But in order to stay there, we need to prove that we won't fall and slip below 31K. And why am I saying 31K? Because you can see how strong that level was here, a resistance, including during the bear market, and during the bull market, it was support so many times. So 31K is incredibly powerful level, and we need to prove to all investors that we are not going to slip below it. If we do that, this will prove to become a deviation, and then we will be back into this range around here. In terms of the weekly RSI, we are currently confronting a level that is pretty tough. If you look back in time, you're going to see that the 70 level on the weekly RSI is usually a pretty tough level to beat. It's not automatically that after 70 we just go full-on bull market. And in fact, that only happens when we are in the actually bull market post-halving event. You can see an attempt here on 10th of August of 2020 that led into a sell, testing and forming structure here in September 2020, which is equivalent to where we are now. So I wouldn't be surprised that this RSI on the 70 starts coming back and retesting these levels, somewhere around the 50 RSI. Doing that will still be bullish because that will be getting us ready for another impulsive move to the upside. From this point, it will be really rare to stay there and start just full-on bull market. Everything is possible, but we are here to talk about what is more likely to happen. That level 50, if we look at the reverse RSI, is coinciding with around 27.3. So even if you touch 27.3, you still maintain intact this bullish structure for a potential bull market upcoming. An explosive move to the top of the range here will take us to unbelievably higher levels of RSI. You can see that we only did that at the very top of the previous bull market, where you reach 96, which is located around here. I think we are not ready for that yet. In terms of probabilities, it's up to you to decide if you want to go with the most likely scenario or with something different. An update on this pattern. I know it all played out already, but in September we were drawing this triangle and we were saying that we were either going to break down to the downside to 20K around here, or there was a target pointing to 31.9. We talked about the breakout and we were following all this pattern. We were saying that we need to hold these lines, and eventually we did what we did. So that was pretty cool now to revisit this pattern after 1 month and see that it actually played out perfectly well. Let's look at the lower time frames. On the 4 hour on the RSI, we can see that we're still on this cool off period. We still don't break this trend line. We keep doing lower lows while the price is still flat. All this range is accumulating more open interest, meaning more positions, people going bearish, people going fully bullish. And I think a safer entry is not necessarily to look into this support and this resistance, because very easily that can be a trap. It's very typical to see moves like this, that they trap liquidity just to go the opposite, or sometimes they come down there, they trap shorts and then they push up. That's why I prefer to use the RSI and to see a confirmation above this, which gives me much higher hedge in terms of deciding in which direction I want to go. In terms of dominance, we were expecting to see the dominance to break above this trend line and be heading towards the 56, 57. Currently, we are at 53.8, but we made a high of 54.3. The structure is still looking bullish and potentially could be heading for higher levels very soon. We can also see how the USDT dominance is coming down. This is pretty bullish because it means that people are using their USDT to buy. To buy what? Alts, Ethereum, Bitcoin. In regards to stable coins though, the stablecoin total market cap has been coming down throughout the whole bear market. And we're starting to see now for the first time that the stablecoin market cap is actually not going down. That's another good news, because it means that at least the money is staying in crypto. And now with the fact that that is flipping into coins, into Bitcoin, is very bullish. In regards to Ethereum, we can see here that the dominance is coming down. It's currently testing this trend line here, which is a level of support and resistance. We can see how many times it got tested. We should be expecting some sort of bounce here, but if it remains below and it tested as a resistance, this could keep going lower. So that's 17%, all eyes on Ethereum. Remember that Ethereum leads the pack with the alts. There will always be outliers in the alts, many coins that are still pumping, but overall, for a safer environment to trade alts, it's usually nice to see that Ethereum takes the first step. Remember the flow of crypto, money goes into Bitcoin, high dominance, then it goes into Ethereum. So currently we are in the stage where we are letting Bitcoin to go as high as it can, find a top, and then we start seeing the flip into Ethereum and then into the other altcoins. Currently we are in Bitcoin season at 16, which is very low, but very exciting as well, because it means that once Bitcoin is done with its thing, then the flow of the money should be coming back into alts. Of course, that is definitely subject to how healthy the S&P and the NASDAQ remains. If they do a major breakdown and Bitcoin crashes following such a big event, obviously don't expect the alts. Alright guys, I hope you enjoyed the update today. If you did, make sure that you're subscribed to the channel, hit the like, and the best thing that you can do for this channel is to leave a comment down below. I really appreciate it. I'll see you in the next one. Take care. Bye bye.